Have you ever had a long-term futures position you wanted to hang on to, but felt the market may not move in your favor right away, if at all? What if you could carry your position while attempting to generate returns as you wait to see if your underlying trade plays out? That's where the covered call strategy comes in. Covered call could be considered a conservative option strategy when trading stocks, though it can be more complex when trading futures, which we'll discuss later in this short. At its most basic, a covered call involves selling a call option against a contract you already have an open position in. In exchange, you collect a premium upfront. Basically, someone pays you for the right to buy that futures contract at the strike price on a certain date. Covered calls can be used by investors who already have the underlying asset. In this video, as an example, we'll refer to the E-mini S&P 500 contract, or the ES for short, which has a contract size of 50 times the S&P 500 index. It's called covered because your position is backed by the option. If the buyer of the call chooses you to exercise, you'd be delivered a short position against the contract you hold. No scrambling to enter a new position in a volatile market. So, what are the potential downsides and risks? As mentioned earlier, there are some risks, especially when it comes to executing this strategy on futures products. One risk with the covered call is that your upside is capped. If the ES future price rallies well above the strike price of the call you sold, you're still obligated to sell at the lower strike price. In other words, you're locked in some profit, but missed out on any gains above that level. On the flip side, if the ES pulls back, you still face the loss like any holder of a long futures position, and you face losses on your short call as well. The premium you collected from the selling of the call may help offset some adverse moves, but it's not a full protection. If the ES sells off beyond what your covered call is able to generate, you are facing a loss on both your options position and your outright futures position. Remember, futures are leveraged, so even covered options against outright futures do not prevent potentially high risk. Given the risk, why would someone use this strategy? It's mainly about attempting to generate returns based on owning an underlying asset. Covered calls can be used if you expect the futures contract to stay range-bound or move slightly higher. You're not looking for a big breakout. You're aiming to collect premiums over time. This strategy can be used by traders managing exposure or trying to lower their cost basis on longer-term positions. Let's look at a quick example. Imagine you are long one ES futures contract from a price of $49.50, and the contract does not expire for a few months. Now the ES is trading around 5,000. You want to keep your long ES position as you are up 50 points on it, but you're not expecting the market to break higher right away. You could sell a call option expiring in a month with a strike price of 5,100 and collect a premium of, say, 15 points. Since each ES point is worth $50, that premium nets you $750. If the ES stays below 5,100 by expiration, the option expires worthless. You keep the $750 and your position. If the ES rises above 5,100, you'll be required to sell at that level. You'd earn 150 points in gains, plus the $750 premium, making a total of $82.50. That's a strong return, even if the ES runs beyond 5,100. However, if the ES trades substantially above 5,100 ahead of or at the time of expiration, your obligation on the short call would still be at a price of 5,100. In short, covered calls can be a strategy utilized to turn longer-term positions into an opportunity to generate additional returns. However, there are risks involved with this strategy that exist especially in leveraged markets. If you're interested in learning more about futures options and various strategies, feel free to contact your broker at EdgeClear to discuss this in more detail. Thanks for watching and happy trading.